Welcome to the Deep Dive. Today, we're venturing into a pretty fascinating intersection.
Hmm.
Mathematics and, well, the stock market.
Hmm.
Specifically, we're going to explore how this thing called the Fibonacci sequence might give us a unique way to look at long-term trends, in the Dow Jones Industrial Average, the DJIA.
That's right. Yeah, you shared this really thought-provoking article, Long-Term Fibonacci Support and Resistance by Kevin W. Murphy.
That's the one.
And it lays out a pretty compelling case, I think, for finding these mathematical relationships, these patterns, at really key turning points in the Dow over decades, actually.
Okay, so let's maybe set the stage a bit. The Fibonacci sequence, people might have heard of it. It's the series starts 1, 1,
Yeah.
and each number is just the sum of the two before it.
1, 1, 2, 3, 5, 8, 13. Keeps going.
Keeps going. But the
Yeah.
really interesting part, for this discussion anyway, are the ratios you get from it.
Exactly. Like as you go further out in the sequence, the ratio between a number and the one right before it gets closer and closer to about 1.618.
The golden ratio.
The golden ratio, yeah. And then its inverse is around 0.618. And there's another key one, the ratio between alternate numbers, which is about 0.382.
Okay.
And it's those ratios 1.618, 0.618, 0.382 that we're sort of looking for in the Dow's history.
Now, this whole idea applying Fibonacci to stocks, it's not brand new. The article mentions Ralph Nelson Elliott.
Ah, Ellie wave theory.
Exactly. He was kind of a pioneer, right?
Mm.
Using Fibonacci for market patterns. He looked at price levels, but also the time aspect.
Yeah, Elliott's work really cracked the door open for this type of analysis. We won't get too bogged down in all the, the complexities of Elliott wave today.
No, definitely not.
But the article we're looking at definitely builds on those initial insights he had about these potential mathematical cycles and market behavior.
Okay, so let's dive into some history then.
Yeah.
The article points to some specific examples. The first big market move it looks at is from the bottom of the Great Depression, 1932, up to the peak in 1937.
Right, so July 1932, rock bottom. The article says the theoretical low was around 40.56.
Okay.
The actual closing price that day was just a bit higher, 41.22.
Then fast forward to March 1937.
Yeah, the peak. Theoretical high around 195.59, closing high 194.40. Pretty big jump.
Huge jump. And here's where the Fibonacci thing starts to, well, potentially connect. If you calculate the percentage gain.
From the 32 low to the 37 high.
Yeah. Whether you use the theoretical numbers or the closing numbers, it comes out somewhere between, 372% and 382%.
Exactly. The article kind of averages it out to about 377%.
And 377.
It's the 14th number in the Fibonacci sequence.
Wow, okay.
Yeah. And the author points out, even if you use slightly different data, different print highs and lows, the percentage gain still lands right around that 377% mark. Plus or minus maybe 2%.
So that first really big recovery wave seems to line up pretty neatly with the Fibonacci number.
It seems that way, yeah. Quite striking.
All right, so that's one correlation. Now, after the market came down again, there was another huge upswing, right? Started from a low in April 1942, ran all the way to February 1966. Almost 24 years.
A long run. Okay, so April 42 lows. Theoretical was 92.69, closing 92.92, very close.
Okay.
Then February 66, the high. Theoretical peak actually broke 1,001.11. Closing high was just under at 995.15.
So another massive gain. What's the percentage increase there?
Works out to approximately 987%.
987, let me guess. Fibonacci number.
Bingo, it's the 16th Fibonacci number.
Okay, that's pretty remarkable again.
It is. The article does mention that if you use like daily print data, the calculation might be slightly different, maybe 971% to 980%. So, it's still within about 1% of that 987 Fibonacci number.
Close enough to be interesting for sure, but is there like a relationship between this 987% gain and the earlier 377% one?
Yes, that's another layer the author points out. 987 is what's called an alternate Fibonacci number relative to 377.
Meaning?
Well, mathematically, it's roughly 2.618 times the earlier 377 number. It represents maybe 2 stages of that earlier growth pattern.
And 2.618, that sounds familiar. Related to the golden ratio again.
It is. It's approximately the square of 1.618.
Right. And the article does this other calculation too, tying them together.
Yeah, this is really neat. If you take the actual closing percentage gain from 32 to 37, that was about 371.6%.
Okay.
And you multiply that by 2.618.
You
get a projected increase of about 972.8%, starting from the 1942 low.
Wow. So apply that to the 42 low.
Apply that 972.8% increase to the closing low of 92.92 in 1942. It projects a closing high of 996.8.
Which is incredibly close to the actual 1966 closing high of 995.15.
Like within a point or two?
Yeah.
Over a 24-year period.
Honestly, that's kind of stunning, the alignment there.
It really is. It definitely makes you wonder, is this just coincidence, or is there
Okay.
some kind of underlying mathematical rhythm to these huge market cycles?
Food for thought, definitely.
Okay.
Okay, let's move forward in time. After that 1966 peak, the market kind of chopped around, right? Tested that 1,000 level again?
Yeah, it peaked in 66, tested 1,000 again in 68, and then again in 1973. That 73 peak had a theoretical high of 2076.2, closing high 1051.70.
But then came a pretty nasty downturn.
Oh, yeah. Between January 73 and December 74, the Dow dropped about 45%, a serious bear market.
And it's this low point in 1974 that the article uses as a base for making some, well, projections based on Fibonacci again.
Right. So December 1974, the theoretical low was around 570.01. Closing low was 579.94.
Although the absolute lowest close was slightly different.
Yeah, the actual lowest close was 577.60 on December 6. And the article even mentions hourly data showing an intraday dip to 572.20 on December 9th. So a few numbers floating around that low 570s area.
Okay, so taking those lows as the starting point for the next potential big advance, what does Fibonacci predict?
Well, the next number in the sequence after 9087 is 1597.
So a 1597% increase.
That's the idea. Apply a 1597% gain to those 1974 lows and see where it points.
Okay, lay it on us. What were the targets?
All right, using the theoretical low of 570.R1, a 1597% gain projects a high of 906.73. Based on that hourly low of 572.20, the target is 970.10.
Okay.
And using the closing low of 579.94, the projection is 942.
So basically a cluster of potential targets somewhere in the, 9,600 to 9,800 range.
Exactly. And remember, this article was written in late April 1998.
Right. Where was the Dow then?
The print high at that point was 9,238.
So getting close to that projected zone.
Getting close. The article suggested that based on this Fibonacci relationship, the market might run into significant resistance up there in that 9,600, 9,800 area. Pretty bold projection back in 98.
It really makes you think about the predictive potential, or maybe just the descriptive power of these patterns. Did the article offer another way to project that move from 74?
It did, yeah. A slightly different angle. Instead of just jumping to the next Fibonacci number, 1597,
Right.
it went back to that original 1932-37 closing gain, the 371.6%,
Okay.
and multiplied that by 4.236,
Right.
essentially 1.618, the golden ratio cubed.
Okay. So another Fibonacci relationship.
Right. That calculation gives a projected increase of 1574%. Apply that percentage to the 1974 closing low of 577.60,
And you get
a projected closing high of 906.69.
smack dab in the middle of that 9,600 to 9,800 resistance zone again.
Pretty much, yeah. Two different Fibonacci-based calculations pointing to a very similar potential topping area.
Fascinating.
Yeah.
So we've talked a lot about price levels, but you mentioned earlier Elliott also considered time. Does the article touch on Fibonacci and time cycles?
It does. It brings up Elliott's idea that these big impulse waves, these major advances, could sometimes be equal in, duration, how long they last.
Okay.
And it points out that the 1942 to 1966 advance, that lasted almost 24 years, to be precise. 23 years, 9 months, and 12 days.
Right.
So the article, written in 98, notes that the time elapsed since the 1974 low was actually approaching a similar length of time.
Huh. So just adding that same duration.
Yeah, if you just add 23 years, 9 months, 12 days to the December 1974 DJIA low, you land somewhere around September 21st, 1998.
Interesting.
And doing a similar thing with the S&P 500's low, which was in October 74, it projects a potential high around July 16th, 1998.
So potential time targets lining up around mid to late 98 as well.
Kind of. The author is careful to point out it's not necessarily precise, because things like the number of trading days changed over the years. They used to trade on Saturdays, for instance.
Oh, right.
So it's maybe more of a general observation, suggesting a possible cyclical rhythm in time rather than like a pinpoint date prediction.
Still, another layer to consider. Okay, finally, the article tackles the big one, the 1987 crash. How does Fibonacci fit into that picture? That felt like a game changer at the time.
It really did. A huge shock to the system. But the article's perspective is interesting. It suggests that massive correction actually stopped. right at a key Fibonacci support level.
Really? Okay, so walk us through that. The high before the crash
It was August 25, 1987. A print high of 2736.6 on the Dow.
and the low.
October 20th, 1987, the print low hit 1706.9. That's a drop of almost 130 points.
Ouch. A huge percentage drop just in those couple of months.
Yeah, the article calculates the crash itself wiped out about 37% of the market's value from the August high. But the really interesting bit for Fibonacci purposes is looking at that drop in the context of the entire bull run.
The one starting way back in 1932.
Exactly. From the 1932 low up to that August 1987 high, if you measure that whole advance.
Okay.
The 1987 low represented a retracement, a give back, of approximately 38.2% of that entire 55-year climb.
38.2%. That's one of those key Fibonacci ratios we talked about earlier.
Precisely. Using the closing low from 32, the calculation is 38.2024%. Using the theoretical low, it's 38.1931%, both incredibly close to that standard 0.381966 Fibonacci ratio.
And Elliott considered that level important, right? 38.2% and 61.8%.
Yeah, those were seen as key potential retracement levels after a big move up, places where the market might find its footing, where buyers might step back in, support levels, basically.
So the fact that the 87 crash bottomed out almost exactly at the 38.2% retracement of that massive multi-decade advance, that's seen as significant support kicking in.
That's the interpretation, yes. A major Fibonacci level holding the line. And the article even sort of extends that idea forward.
How so?
It suggests that if the Dow eventually reached that projected 9,600, 9,800 resistance zone we discussed,
Right.
then if a correction occurred from there, you might expect potential support to show up at the 38.2% or maybe the 61.8% retracement level of the advance that started from the 1987 low.
Ah, okay. So using the 87 low as the new base for calculating future support zones.
Exactly. Those levels could become important areas to watch if the market pulled back from those higher targets.
All right, so pulling this all together,
Mhm.
it seems this article makes a pretty strong case using historical data for these potential links between Fibonacci ratios and really major long-term moves in the Dow.
Yeah, it identifies potential resistance up near the high 9,000s based on cycles starting way back, and it highlights moments like the 87 crash where these Fibonacci levels seem to act as critical turning points.
It's definitely compelling stuff.
It is, but, it's crucial to remember these are historical correlations. Fascinating ones, absolutely. But there's no guarantee they'll hold true in the future.
Right. Past performance is not indicative of future results, as they say.
Exactly. The market's incredibly complex. Lots of factors influence it. This Fibonacci stuff is just one lens, one possible framework for trying to understand its long-term behavior.
Absolutely. But it's a lens that certainly makes you think, doesn't it?
Yeah.
How these, seemingly abstract mathematical ideas might actually offer a different perspective on market cycles compared to just looking at earnings or economic data.
It does. It opens up questions about what other kinds of underlying patterns or even mathematical principles might be subtly shaping these complex systems we deal with.
Yeah, definitely some provocative food for thought there for anyone watching the markets long term.